They told you the economy was fine. They told you the banks were stable. They told you rising interest rates were under control. But right now, buried inside a $2.5 trillion corner of the financial system that most Americans have never heard of, a slow-motion collapse is already happening. And the people running it have figured out a way to make a sinking ship look like a luxury cruise liner, at least on paper. This is the story of private credit. And this story has already begun. To understand why this matters to you, we have to start with one number. The 30-year Treasury yield just hit its highest level since 2007. Now before your eyes glaze over, stay with me for 30 seconds. Because hidden inside that number is something that controls the price of money across the entire economy. When that yield rises, the cost of borrowing rises everywhere. Mortgages, car loans, business debt, all of it. And for the first time in nearly 2 decades, that number is flashing a warning signal so loud that even the bond market, the most boring, predictable, fall-asleep-at-your-desk corner of finance, is starting to scream. But here is what makes this story different. The real damage is not happening in the part of the market you can see. It is happening in the dark. In a world of private loans that never trade, never get publicly priced, and get valued on a schedule that is decided by the very people who own them. A world where a company can be quietly drowning and still show up on the books as perfectly healthy. And a world where investors are receiving cash dividends on money that was never actually collected. To understand how we got here, you need to understand what private credit actually is. Think of it as the shadow lending system of the American economy. It fills the gap for companies that are too large for a small business loan, too small to issue bonds on Wall Street, and too complex for a traditional bank. So they turn to private lenders, firms that operate away from public markets, away from the daily scrutiny of stock tickers and news headlines. And those private lenders have built a $2.5 trillion industry doing it. Now here is where the story starts to get dangerous. The vast majority of loans inside the private credit market are what is called floating rate. Unlike a fixed-rate mortgage where your payment is locked in forever, a floating-rate loan moves with a benchmark. And the benchmark almost everyone uses is called SOFR, the Secured Overnight Financing Rate. Think of SOFR as the overnight heartbeat of the entire American financial system. It is a real number, published every morning, based on actual transactions. And in early 2022, SOFR was effectively zero. Then the Federal Reserve started hiking rates. And by mid-2023, SOFR had climbed past 5%. That means every single company that borrowed money on a floating-rate private credit loan suddenly watched their interest bill more than double overnight. Not because their business got worse. Not because they made any mistakes. Simply because the benchmark their loan was tied to moved. And when your interest payments double overnight, the math stops working very quickly. The case of Pluralsight shows exactly how this plays out in the real world. In 2021, private equity firm Vista Equity Partners acquired Pluralsight, a software company, for over $3 billion. They funded the deal the way private equity always does, some equity, and then over $1 billion in floating-rate private credit loans loaded directly onto Pluralsight's balance sheet. When SOFR was near zero, the interest payments were manageable. When SOFR crossed 5%, the payments became impossible. By August 2024, it was over. A group of private credit lenders had to step in, convert their debt into equity, inject an additional $275 million of fresh money into the business, and in exchange, they took 85% of the company. The original owners were nearly wiped out. And Pluralsight is not a rare case. It is a preview. Because earlier this year, the Fitch private credit default rate, which tracks more than 500 middle-market borrowers, hit 6% on a trailing 12-month basis. That is the highest level ever recorded since the index began. And the private credit market has grown nearly 10 times in size since 2007, which means 6% of a much, much larger number is a very serious problem. But here is where the story gets truly strange. Because even as the default data is breaking records, the funds running this money are still reporting healthy income, still paying out dividends, and still telling investors everything is fine. And they are doing it using one of the most creative accounting structures the finance industry has ever produced. It is called a payment-in-kind feature, or a PIK. And what it does is almost unbelievable when you say it out loud. A PIK feature allows a borrower to make their interest payments not in cash, but in the form of additional debt. So instead of sending the lender a cash payment, the borrower simply adds the unpaid interest onto the principal balance they already owe. The total debt grows. The cash never moves. And here is the part that should make you stop and reread this sentence. The lender then reports that unpaid interest as income. Real income. On the books. Money that was never collected, never transferred, never existed as actual cash, reported as earned income. And it gets worse from there. A large portion of private credit operates through investment vehicles called business development companies, or BDCs. These funds get a special deal from the government, zero corporate income tax, but in exchange they are legally required to distribute at least 90% of their taxable income to investors every year. So here is what the full picture looks like. A company that cannot afford its interest payments flips to PIK. The unpaid interest gets added to the principal. The fund reports that phantom interest as taxable income. And because the law requires 90% distribution, the fund writes a real cash check to its investors, a dividend paid out of money it never actually received. The higher rates rise, the more borrowers struggle, the more PIK gets used, the more phantom income gets reported, and the larger the dividend that must be paid out on cash that does not exist. This is not a theory. Around 11 to 12% of all private credit loans now include PIK features, an increase of more than 72% since the end of 2021. More than half of those PIKs were not part of the original loan agreement. They were added later, after the borrower started showing signs of stress. And across public BDC funds, roughly 8 cents of every dollar reported as income is interest that nobody actually paid in cash. At some funds, it is far worse. FSKKR was running PIK income at more than 14.5% of total investment income, and their non-accrual loans, meaning loans where borrowers have stopped making any payments at all, reached over 5%. In JP Morgan's third quarter 2025 earnings call, CEO Jamie Dimon was asked about the cracks appearing in the credit market. His response was simple. He said, "When you see one cockroach, there are probably more." And the data is proving him right. Earlier this year, Fitch recorded 11 default events in a single month, nearly double the 2025 monthly average of 5.9. And of those 11 defaults, more than 60% involved the introduction of payment-in-kind interest instead of cash payments. But there is one final layer that ties all of this together. Because the problem is not only how the income gets reported. It is also about how the loans themselves are valued. Since these loans never trade on any exchange and there is no public market price you can look up, they fall under an accounting classification called Level 3 assets, the most illiquid and subjective category in all of financial reporting. Their value is determined not by the market but by internal models run by the same funds that own them. And MSCI recently found that more than 10% of private credit loans were already marked down by at least 50 cents on the dollar. Meaning the real losses are already there. They are just being hidden behind models and accounting labels. And now all of this is heading toward a wall. A maturity wall of roughly $85 billion in BDC loan maturities coming due between 2026 and 2029. All those companies that borrowed at near zero rates are going to have to refinance at today's rates. And when that happens, the PIK features and the Level 3 valuations and the phantom income dividends will run out of road. Because you can hide a loss inside an accounting line. You can roll unpaid interest into a bigger principal. You can call a distressed borrower a performing loan. But the math is still the math. And bad math does not just disappear. It waits. The question is not whether this wave hits. The question is whether you see it coming before it does.